Okay, well, welcome everyone. Hope you're having a great Wednesday so far. Really excited as we dive in deep into the topic of revenue management today. My name's Stevie Harris. I'm a program manager with the Storage Group, and our presenter today is Tracy Sells, owner and operator of Route 1 self-storage locations in Maryland, Vero Beach self-storage, and also principal of Harbor Storage Group. That's one of the reasons that Tracy is so qualified to speak on this topic today. It's very clear she wears many hats. Before we go ahead and get started, please see that Q&A box at the bottom of your Zoom webinar screen. Please feel free to input any questions you have as we go through the presentation, and we'll be sure to answer and address those at the end. We're also recording this presentation, so we will be providing that to everyone in attendance, and then those also who were able to attend. With that being said, thanks for joining us today, Tracy. Grateful
Thank
to have
you.
you willing to share, your knowledge on revenue management with us. I feel like this can be perceived as a taboo topic in our industry. What's your perspective on this with revenue management?
You're right. I think it's perceived as taboo because it can be challenging. It can be a bit daunting. And when you read about the big REITs and all they're doing in revenue management and the big departments that they have and the complicated algorithms and programs that they use to manage their revenue and their rates, and we get overwhelmed. But I think what we can all do as smaller owner operators is take away a few things from what the REITs are doing and implement them at our facilities. I've been fortunate enough to have worked for two of the big REITs in my long career in self-storage, as well as a regional operator with about 150 stores throughout the country, and in the third-party management programs of all three of those positions. I had the benefit of learning from these bigger companies and some of the practices that they follow for their revenue management. And so between that experience and my continual reading and staying abreast of what's going on in the industry, as well as my day-to-day operations of my three facilities, I spend a lot of time on revenue management, and hopefully I can share some things with you all that will help you as you look to grow your revenue and increase your return on investment at your facilities. This is just a little bit about my background, which Stevie and I just talked about. And Stevie, thank you for your kind introduction. Just to overview of what I wanted to cover today, I think it's important to touch base on where the industry is today, as that has an impact on what we can do with our rates. So we'll talk a little bit about that. We'll talk about obviously revenue management and when to increase your rates, understanding some of the basics of revenue management, things to consider, some tips and tools that will hopefully help you, and some strategies going forward that hopefully you'll be able to implement at your stores. So we all know, I mean, look, we went into, a year ago, we weren't exactly sure what was happening with COVID and where the industry was headed. The first few months of COVID were a little bit challenging for all of us. I think it was more the uncertainty than the reality of what was to come. But anyway, we've all fared very well during the last year and a half. And the REITs, who obviously report their numbers publicly, experienced significant growth in the first quarter of 2021. If you look at their same store revenue from the same period last year, revenue grew 6.2%. That's pretty strong. And their net operating income grew 8.4% in the first quarter of 2021 versus the same time last year. So I think what we're seeing is some very positive results in the industry, and I am sure that many of you are experiencing the same kind of growth in your businesses. And if not, hopefully this will help you to be able to experience some of that yourselves. There's plenty to go around. At the end of the first quarter of this year, the average occupancy of the 5 REITs was almost 95%, up from 89% a year ago. So not only are we seeing growth in revenue, but we're seeing growth in occupancy, which bodes well for our ability to raise our prices, which we'll talk about a little bit more when we get to that slide. This slide shows you kind of the year over year rental rate, the history of where how rates have been growing year over year since 2017. And it's pretty clear 2021 stands out tremendously. And I won't spend a lot of time on this. Stevie, can we make this presentation available after? I guess there'll be a recording as well. But if anyone wants these slides and it's not possible through the webinar, just reach out to me and I'll be happy to share them. But I won't go into too much on this. I think the picture tells the story that 2021 has just been phenomenal for self-storage, the growth and pricing. Why the increase in demand in self-storage? Why have occupancies gone up year over year? Why have revenue rates continued to grow? We all are seeing a booming housing market. I can't think of any communities where I've read about that aren't experiencing tremendous growth in housing markets, lots of new development, lots of moving, lots of selling, so on and so forth. Move outs have been a little lower this year than they were in previous periods, helping us all with our occupancy. And as we've all experienced, the remote work and school have really driven people to use storage that might not otherwise have used it. We kind of know that storage demand is often driven by a life event, such as a death, a divorce, a change in home, that kind of thing. But this remote working and school also seems to have driven demand for storage as well. So these are some of the factors that have gone into the positive results that we're seeing year over year. So talking a little bit about revenue management, I pulled this definition out of Wikipedia just to show you one perspective and kind of the official definition of it. The application of disciplined analytics that predict customer behavior at the micro market level, which we all know self-storage operates pretty much at the micro market level, and optimize product availability and price to maximize revenue growth. The primary aim of revenue management is selling the right product, a unit in our case, to the right customer at the right time for the right price. Just one version of the definition. Now, I also went to Inside Self Storage and pulled another definition that I thought maybe was more relatable. Self-storage revenue management isn't just about sending rate increase letters when your bank account gets low. It's the process of getting every dollar from your storage facility that the market will allow. And I think that's important. And that's where it gets a little overwhelming sometimes. Well, how do we actually do that? So there's some tools that I'd like to share with you that help me, and maybe you can use them going forward as well. So when we talk about revenue management, there are a lot of different moving parts, if you will, things to consider. We have a wide range of customer needs and customer segments, anything from student facilities and student college towns to mature facilities to stabilized properties and lease up properties. So we have a wide variety of factors to consider when we're talking about revenue management. We also have different unit sizes, different types of units, climate control, non-climate control, elevator, non-elevator, ground floor, so on and so forth. And locations are, like I said, upstairs, downstairs, outside unit versus an interior unit, that kind of thing. Storage is seasonal. We know that. I think it's been a little less seasonal this past 12 to 15 months. But typically we see the peak season being right about now for a few months and the slower season being right around the holidays and lasting another couple of months until the spring starts to hit and everyone gets ready to clean out and move and sell their houses and so on and so forth. So in terms of revenue management, there's not one size fits all. Again, it's back to what kind of property do you have and what kind of units do you have? And where are we in the cycle of the seasonality of the business, or where are you in the cycle of the maturity of your facility? So there's different things to consider. And again, we also deal with new development coming on in a lot of our markets. We've seen that everywhere the last year and a half, even longer, quite frankly, but especially the last year and a half. And what are your competitors doing with their pricing? So there's lots of things to consider, right? And I think that's part of why it gets a little overwhelming sometimes. So some other things to think about as you're going to prepare kind of a revenue management strategy. Different things to consider. Your existing tenant rates, how often do you increase them? What kind of rate increases do you give them? How do you determine what that is? Is it by occupancy by unit type, or is it just across the board? That's one piece of this. The street rates, what are you charging for a new customer? And how do those street rates compare to your existing tenant rates? What kind of discounts and promotions are you offering? Those are things to consider as well. I just talked about the occupancy levels by unit type. What kind of trends are you seeing in the business? Are you getting a lot of inquiries for a 5x5? And maybe that gives you a little more opportunity to raise the 5x5 prices. Are you seeing lots of demand for drive-up units versus interior units? So all those things that help you make decisions to be optimizing your price point at different variables and levels within your facility. And then based on the trends and the data that you have, what do you expect to happen going forward? If it's December 1st and we know the season's going to slow down a little bit, is that the time to raise prices? So you have to think about what lies ahead as you look at your revenue management program and implement that. As we talked about earlier, it can be challenging, but I know that everyone on this webinar can handle it, given the right tools. Also, there are lots of resources available to help you. Your software has a module, I'm sure, for revenue management that can be very helpful. And if you don't understand it, get the help from the online resources by your software provider, or call them and schedule a time to go through it. And there are companies that help you guys, that can help you with how to formulate the best revenue management strategy and how to implement that. Think about this, that high occupancy doesn't necessarily equal high rent or revenue. A facility that's 100% occupied may not be getting the best rates for their units. And you could be 95% occupied with better rent rates and getting a greater level of revenue at 95% than at 100%. So it's not always about the occupancy. And I think that trips some people up some of the time. Increasing prices doesn't always mean a tenant will leave. I think that's oftentimes the fear, especially at the front line with the managers. They don't like to hear any pushback from tenants. They don't like to have to say, yeah, I'm sorry, we had an increase because our taxes have gone up, our utilities have gone up, that kind of thing. They are not comfortable explaining a price increase, and they are not comfortable when a tenant leaves. But in some cases, and I have an example of this later on here, it's better if a tenant leaves. If you're highly occupied and you've got someone paying below street rate and they are not happy with a $5 increase, then it may be in your best interest to let them move out and replace that tenant with someone that's paying more than they were. And don't trust your gut. Use the data, use the tools, use the trends, use the history, and use your kind of ability to predict what's going to happen to help you set the right pricing. So again, we touched on this, but there are a couple of different components. Existing tenant rate increases. How often are you raising prices? Are you doing it once a year? And if so, is that enough? Once someone moves in, are you giving them a first increase maybe after 5 or 6 months, like a lot of the big guys do? Are you then doing every 6-month regular increases? What are you doing? And that's something that you need to consider. What are your strategies on the whole existing tenant rate increase section of revenue management? And your street rates, how often are you analyzing your street rates? I look at mine 3 or 4 times a week. The REITs we know are looking at theirs every day. But if you're not in a disciplined practice where you're checking your street rates and making sure you're optimizing them on a regular basis, you may be missing out. And what is your strategy, and what methodology are you going to use to optimize those street rates? Discounts and promotions. Are you, is there a chance that you're giving away too much in discounts? If you're highly occupied, do you need to be giving any discounts? Do you sometimes take away a discount or, decrease the amount of a discount in a particular unit type? I will tell you, my store in Florida was previously managed by a third-party management company where they were offering discounts to seniors, which is lovely. But when you're in Florida, everyone's a senior. So we found that a huge percentage of our customers had a discount, a senior discount that added up to a lot of money. And I'll show you that example a little later and how that's impacted us and what I'm trying to do to overcome that. But, think about those things. Just because a discount's been in place forever doesn't mean it needs to continue to be in place. So here's an example of what I talked about, that high occupancy doesn't always equate to high rent rate. In this case, it does, but we could tweak these numbers and show an example where it doesn't. But today, where I made it simple with 100 units at $100 a unit, and we have 91 occupied units, which equates to a gross potential income of $9,100. Where you think, wow, I'm 91% full, I'm going to really push my prices. So you raise them 5% to $105, and you get 4 new rentals in the next month. That's great. You get 9 vacates. We always have vacates, right? So you end your occupancy at 86%, and your ending gross potential goes down because you push that rate to 105, and you only got 4 new rentals. But let's look at it a more a modest approach to raising prices. We said, okay, we're going to raise it to $102 instead of $105. And because of that lower price point, we got 10 new rentals. We're still above the $100 that we were at, but now we're at 102, and we got 10 new rentals instead of 4 new rentals. We still have the 9 vacates. We ended up with higher occupancy, and we end up with a higher GPI, 3% higher by forecasting your revenue. So what we said in this scenario is that we know we're going to have vacates, and let's not push our price so much that we don't overcome those vacates with new move-ins. So back off a little bit on your pricing. The unit price is lower, but your ending GPI is higher. So back to my point of, your gut isn't always right. Just because a unit price is higher doesn't mean it's going to equate to a better gross potential income. And a couple of things that I think that we all should think about as we evaluate our revenue management program. As I just touched on, the goal is to maximize our revenue, not our occupancy. And in my years working in third-party management, I've often heard an owner say, well, I'm 100% occupied, so I'm happy. Well, no, you're not getting the best rate necessarily. So let's look at it. Doesn't mean revenue management will or will not. It should increase your revenue all the way across the board, but you have to look at it and analyze it and run some numbers and set some goals so that you can optimize your revenue, even if it costs you a couple of occupancy percentage points. Forecasting demand, like we talked about, kind of what is going to happen at your facility is more important than what has already happened, right? But you can use that historical data, what has already happened, to help you predict what might happen in the future. And it might mean looking back a year at the same time of year instead of looking back a month. But there's historical data available to you through your operating software that you should be using to help you predict what's going to happen going forward. Be original. Don't necessarily follow your competitors for facility pricing. Their strategy may not be better. Evaluate your pricing frequently, like we touched on. We know the REITs do it daily, if not hourly, and use the available resources. If you follow these practices, I think you'll be in good shape to get started with a robust plan that will benefit your facility. So talking about my facility in Florida, this is I thought was a good case study. Aside from the fact that we have a lot of people in there that are under the old senior discount, okay? But some important facts on this particular facility. It opened in October of 2017 and reached stabilization in about 30 months. So I pulled some data beginning with July 2020 through May 2021. And to show you, I've really been pushing revenue. And in spite of the manager saying to me after the first increase, well, I don't think you want to push anymore. You know, people won't rent for that. Well, they did rent for that. And then I pushed them again and they continued to rent. So what I've been able to do over the last 10 months is not only raise our occupancy significantly, which I think we're all seeing growth in occupancy, right? Which is wonderful. But let's use that occupancy growth to take it to the next level and raise our income and projected rent. So our gross potential income grew quite significantly over those 10 months because I was pushing rates. Now the projected rent is where we're falling a little bit behind, and there's a big gap between projected rent and gross potential, which we don't normally like to see. But that's because of those senior discounts, which I have, by the way, eliminated at the facility. I did not take them away from the customers that were currently on them, but no new customer gets them. But look at what we've been able to do with that projected rent, even including those senior discounts. And that projected rent is going to go up as more of those seniors on that discount vacate and are replaced by customers that do not get that discount. And look what we've been able to do with our achieved rent per square foot. So not only, you know, were we aggressive and it's paid off, it's worked. And sometimes I question whether I should have been more aggressive, but I think we have a good balance here. We increased the frequency with which we're raising tenant rates from once a year to every 6 months. And we may change that again in 6 months and say, well, that's too frequent. But for now, that's what we're doing. And we've had no pushback whatsoever. So just to show you, you know, the visual of what's happened with the achieved rent per square foot, you know, it's a compelling story where I've pushed rates and it hasn't hurt us. Occupancy dipped a little bit. We got to as high as 100. Nobody should be at 100% occupancy. So I pushed rates again. And we're down a little bit. But in this particular case, as frequently as I've raised prices and by the pretty healthy rate that I've increased them, we're still full. And then there again is what's happened with the gross potential on the projected rent. And if I'm ever invited back to do another webinar and use this particular facility as a case study, that gap between projected rent and GPI will be a lot smaller as we eliminate those old discounts. And so you kind of get the gist of what the basics of revenue management are. But another key strategy that I use that has really helped me is kind of a tiered pricing model. You know, somebody's probably willing to pay more for the unit that is closer to the door than the one that's 100-foot push from the door, or the one that's outside right underneath the light versus the one that's a couple of units away from the light. So why don't you charge a premium for some of those units? Your average unit is good. It's you know, it's better than good, right? So let's say you have a better unit at $100. It's the average unit and it's a good value. But those premium units that I talked about close to the door or the gate, whatever the case may be, customers may be willing to pay a premium for that. There are some customers who are more cost conscientious and say, well, you know what, I don't mind walking that 100 feet from the door to my unit. And you offer them a little bit of a discount, but it's a way to upsell and to get a higher price per square foot for units that are valuable to people. Just like when you go and buy meat at the market, are you willing to pay extra for that prime meat? And some people are. So why not leverage that and set some different price points and accommodate a variety of customer needs? So yeah, the benefits of value pricing are that you're providing options to your tenants, and you're also, ensuring them that they're getting the best value for the unit. Um, and it builds purchasing confidence amongst customers, and it maximizes your profit potential. And then okay, so, I'm sorry, and I'm going to come back to this a little bit. Just as a summary of what we just kind of covered here, I think that I agree that the industry is well positioned to maximize revenue right now. So use this wonderful period within the self-storage space to look at your revenue and see if there's opportunities. Don't follow your gut. We talked about that. There's lots of good data out there, lots of good articles, tools within your software, third-party vendors that sell revenue management tools, companies that specialize in revenue management that can help you. So take advantage of those resources. High occupancy doesn't necessarily mean high revenue, and consider the tiered pricing model, which I just talked about, which the Click and Store online rental suite, which I use, is a phenomenal way to take advantage of this kind of tiered pricing. And you'll see on the screen here that you have, a 10 by 10 unit that has 3 different prices. And you can see that there's different, this actually doesn't show the proper descriptions, because the good unit may not be next to the gate access door. The best unit probably is. The better unit might be 15 feet or 20 feet away. So that's a little bit deceiving there. But I use this and I really appreciate this rental tool. I chose it over other options that are out there because of all the features that you get that are hard to find elsewhere. Revenue management is, as I mentioned, a strategy that I'm constantly assessing and implementing across my facilities. To have these value pricing features embedded automatically for my tenants to choose from, it helps make my revenue management goals easier to achieve, saves me time, and increases my net operating income and return on investment. And so this is an example of how this potential tenant can go online, look at a 10 by 10 unit and see several different options. And before they complete the rental process, they pick, and then boom, you're done. So it's an easy decision-making tool for the customer and this is a demo, so it's not going to be exactly right, but when you see that the good unit might be, at the end of the hall, the better unit might be in the middle of the hall, and the best unit is next to the door. So you'll see that on the actual live version of Click and Store. But if you don't use Click and Store, it's something that I would consider evaluating. I think it's a special tool that has certainly helped me tremendously in my revenue management practices at my store. And with that, that's all I have for today. Again, feel free to reach out to me for questions. I know we have time after this to talk about some more questions, but this is my contact information, and I would love to hear from any of you with any questions you may have or thoughts, and to keep in touch. So hope this was helpful. Thank you, Stevie. And with that, I'm going to turn it back to you. I think you're going to lead the questions, right?
Yeah, well, thank you so much, Tracy. That is such valuable information and very relevant to what's going on in our industry right now. So yeah, there was a question that came through from, looks like Forrest Thomas. So he asked, how do high temperature climates affect the season? Summer, slower, question mark.
High temperature climates. I think that what I see in my Florida store versus my Maryland stores, where the temperature is definitely higher in Florida, right, all year round. You still see a slowdown sometimes during that typical winter holiday season. A lot of the seasonality is built around when people move, and typically people move when school's not in session. So the summer tends to be a little busier and higher demand. But higher temperature units, I think there's also a lot of snowbirds in those higher temperature climate. So that impacts this timing of vacates and move outs. And in my Florida store, for example, last year, this year is not a fair comparison analogy because nobody's moving out. But last year when the snowbirds came to town, some of them moved their belongings out of storage, put them into the homes that they were renting. And then when they left Florida for the season, let's say in May, they put their goods back in storage. So there's lots of moving parts, but I think the warmer weather does have an impact based on these snowbirds that tend to be in those climates.
Okay, great. That's a good answer. I guess next question here was, how did you help your managers overcome those difficult conversations with tenants on unit rate increases? I know that's always dreaded,
No,
and it's difficult.
yeah, that's a really good question. And what I did was I even showed them some numbers that our costs go up to operate these facilities, right? We have to pay snow plowing vendors in the winter. We pay our gas and electric bills, our water bills. They all go up year over year. The big one is property taxes. You explain to your managers and explain to them, and I use their wages as an example. You want to raise every year, right? Well, that costs me more. And while I'm happy to do it, if we keep raising your rate, your hourly rate, and then we keep paying more in utilities and property taxes, and we don't increase our rates, eventually we're not going to make any money here. And this is a business. But I show them the tax bills and let them see the big difference. And I used their salaries as kind of the example. And I also explained to them that if somebody, and I drew out like a diagram of if someone moves out that's paying $100 a month because you raise their price to 103, that's okay because the street rate is 105. So, I went through specific examples with them and try to make them understand that a vacate is not necessarily a bad thing, depending on where you are with your occupancy and your rent rates. I hope that helps. That's a difficult question, and every manager is going to be differently receptive to your answer, but I found that using real live examples helped me.
Okay, that's great. So another question from Forrest came through. So could you discuss factors you consider on increases for existing tenants with multiple units, late payers, etc.?
I really look at the occupancy by unit type. And then I factor in kind of what the competitors are doing on that unit type, although that's not really my end decision making. It's basically occupancy by unit type. And then I say, okay, when was the last time this customer had a tenant rate increase? I don't factor in whether they are late payers, any of the kind of the more subjective factors. It's strictly an analytical numbers thing with me. And then, I might give the manager the opportunity to say, if someone comes in that's been a great paying tenant for years and is in a really difficult situation and doesn't say that they've got COVID 100 times a year, but is genuinely seems legitimate, I might say to the managers, okay, split the rate increase with them, but don't not give them one. My managers don't have that ability in the system, but I look really from a data perspective and where we are in the season and where I think we're going to be with that unit type, what the demand has been. But I try to take the subjectiveness out of the equation, because then it gets challenging because everyone has a different situation.
Yeah, that's a good point that you make there, Tracy, for sure. So next question, what policy do you have for increasing tenant rates above standard rate? How do you justify the increase?
I don't increase my tenant rates above the street rates. So, but because I'm constantly evaluating and moving my street rates, there's usually a fair number of tenants that are still paying below the street rate, because presumably my street rates are going up over time, right? As we saw with the REITs, if they're up 6% year over year, they've obviously increased their street rates. So I say, okay, then tenant rates should be moving in the same direction as the street rates. But there will always be the case where someone is paying above the street rate and no, I don't increase them unless they haven't had an increase in a really long time. But that's pretty rare. But you can also, if you get pushback from someone, it's a function of supply and demand, and their unit type might have been more in demand. So you could raise their particular price more than you might have another unit type that is not highly occupied or has not seen a lot of activity or inquiry, that kind of thing. Again, it's a good question. It's a challenging one. And I'd be happy to talk to you more about it offline and share some more of my personal experiences with it. But hopefully that helped a little bit.
So next question here from Kent. What dollar amount increase is too much? We have tenants that have not had an increase in 4 years. Some are around $30 below current street rates.
I usually set a maximum in my software that says the minimum might be $5 a month and the maximum might be, $20 or $30 a month. That's an individualized question. Where are they compared to street rates? If they're $50 below street rate, what's the harm in raising them $40? What's your occupancy? Can you afford for someone to vacate? Is your street, how much higher is the street rate? It's a difficult question to give a blanket answer. I would want to say, look at your rent roll, look at where they are versus the street rate, and get as much from them as you can. Can you afford for them to vacate by going up as high as, if they're paying $50 below street rate and you raise them 50, what happens to you if they move out, right? Can you resell that unit at $50 more or not? So it becomes, it's a question about what are the implications of that increase and how can you overcome those?
Okay, great. Now, a question from Rick. In cold climate areas, isn't it best to do price increases in dead of winter, say December, January, or February? Do you feel people are less likely to move out during that time frame, or do you just not worry about the vacates?
I mean, I don't look at it by season of when I raise my rates. I look at it by occupancy of that unit type and about what I think is about to happen. I don't know. I mean, as an industry, it's pretty rare for someone to vacate even in the warm weather, right? It's a hassle to rent a truck for the day and spend your whole Saturday vacating over a $5 or $10 rent increase. You're going to spend the year's worth of cost increase on the day renting the truck and all your time that is involved in moving to another storage facility to save $5 or $10. So I don't believe that raising rates in the winter months in a cold climate is going to have any less impact on the vacates. I just don't see much of an impact, period, regardless of the time of year. I think it's more of what's the cost of people to actually move their goods.
Yeah, I would agree with you there, Tracy. I just going through the process of moving right now and having my items in self-storage. If I did get a call tomorrow, we've had some of our items in there for a few months. Would not want to go back through the hassle right now of having to move to another unit just due to price. So I would agree with that sentiment there. Next question. So what percentage should you increase a tenant's rate by?
That really varies. I think it depends on what is your occupancy level of their unit type. I think it depends on what kind of demand, how many rentals have you had on that particular unit type in the last 30, 60, 90 days? What kind of inquiries do you get on that unit type? If it's a popular unit type that's in high demand, and let's say it's a climate controlled unit and it's 100 degrees outside, you can probably push a little higher there than in a 5x5 where you're lower occupancy. That's climate controlled. So there's lots of moving parts, but I don't have a one size fits all answer for that. I'm sorry.
Okay. Well, I think that's about all the questions that we have. So with that being said, Tracy's information's up on the screen, and we'll also be following up with everyone via email with the recordings and the presentation slides. So thank you so much again, Tracy. It's been a
Well, thank you for
pleasure.
having me, Stevie. It was
Yeah,
fun.
thank you. Well, take care, everyone. Have a great day.
Thanks.
Bye.
You too. Bye-bye.